Hi everyone, this is Jennifer Peel. This is the last video, the fourth video of the four-part videos about how to find cash funds, creative ways to find cash funds to purchase your real estate. In this video, it's me and Ryan talking about how to utilize life insurance or insurance plans to tap into or to find those cash funds to purchase real estate in the future. So let's get started. Hey Ryan,
Hey,
how are you doing today?
I'm doing well.
Well, thanks for meeting with me on the Zoom. So how long have you been in insurance? Or how long have you been a financial advisor?
I'm not a financial advisor because you need a special license to call yourself that. However, I do a lot of financial planning. I educate people with money concepts and different types of vehicles where they can park their money so that they can grow their wealth. But I've been licensed in life insurance since 2018. So coming up on 6 years.
Oh, nice.
Yeah.
So there's all this talk about, using your insurance to pull out cash funds. And I know there are a few people out there that use their insurance to pull out the funds and purchase real estate. Are you familiar with that method?
Yes. So yeah, you can use a life insurance policy to, accumulate cash because you can earn interest inside of the life insurance policy. And then in the future, you can access those funds to use for down payment for a home, for purchasing cars, paying down debt, a lot of different things.
Yeah. So how would that work exactly? Like, is there a particular type of insurance that one would need to purchase?
Well, first, yes, you would need to have an insurance that has cash value attached to it. So a term insurance, because it's so cheap, there is no cash value inside of term policies. So you will need something like a permanent life insurance policy. Most permanent life insurance policies have a cash value aspect, and there are many different types of permanent life insurance policies. So whole life is one of them. Universal life, variable universal life, or index universal life. And what differs among them is how they accrue interest and how you can fund the policy. So
which one grows fastest?
Well, I mean,
which one is the one with the highest interest?
Well, I can tell you for one that the whole life policies and regular universal life insurance policies have a fixed interest rate. So you're guaranteed, a set amount of interest. But usually, in those policies, the fixed rate is around, 3 to 4.5%, maybe even 5%, 5.5%, which is not that much, right? You can put your money into an investment product like an IRA or 401k, Roth IRA, and you can earn more interest. In the variable universal life, your cash value is invested into the stock market, so different things like mutual funds and stuff like that. However, you are exposed to market risk. So, there is no limit to how much you can earn. However, you are at risk to losing, some or all of your cash value because of market fluctuations.
That makes sense. So what are there like any, so let's say I open up an insurance policy, I make these payments every month, it starts to grow the cash value because there's two things, right? You have your cash value, and then what is the other part of your insurance called?
So when you make a premium payment to the insurance company, a portion of that premium payment goes towards the cash value side, and then the other portion goes towards your cost of insurance, any premium expense charges, or any other fees that the life insurance company charges you. So it is important that you have someone who knows what they're doing to design your life insurance policy properly so that you can get the most out of it.
Okay, so then I make these payments, it grows this cash value that I can pull out at any time. Can I pull out like the full amount of the cash value, or is there restriction?
You can. So most times the life insurance policy, there is something that's called a surrender penalty or a surrender value during the policy. So most surrender periods for life insurance companies are anywhere between 10 and 15 years because it's meant to be like a long-term deposit or a long-term savings. So if you were to cancel the policy early, you may not get all the money back that you put in. However, the longer you wait or the more that you fund into the policy, you can definitely pull out more money when you need it. So it depends on, the insurance company, their guidelines, their parameters. Every insurance company is different. I work with an insurance company that has, it has a 15-year surrender period. However, you have a lot of, I guess, options when it comes to taking money out to, spend and use it for things.
Okay, so I think I heard something about pulling out like a credit against your. So if I don't want to, like, let's say that time frame hasn't passed, it's maybe 6 years or 5 years, but there's a good amount of cash value in there I kind of want to utilize, maybe for the earnest money deposit, maybe it's, properties in Hawaii are a little bit higher, but maybe it's an investment property on the mainland that where the down payment is only like 10,000. So what if isn't there a way where I could just pull out like a credit based off of my insurance?
Right. So the way life insurance loans work, I guess you can say. So there's a difference. You can take a withdrawal or you can take a loan out of your policy. And the difference is when you take a withdrawal, basically you're just pulling out money. And you may be subject to capital gains tax at that time. If you have earned more interest than the amount of premiums you paid in, if there's a profit in that policy, then you will be subject to capital gains tax. However, the same policy, if you just access those funds via a loan, that's the loophole. You bypass the capital gains tax. However, with loans, you are associated with interest rates, right? And different companies have different loan provisions. So you may or may not have to pay interest to borrow the money, because actually the life insurance company, if you're taking a loan out, they're not loaning you your cash value money. They're giving you a loan credit of whatever your cash value is, and they're going to borrow that money. You're going to borrow that money out of the life insurance company's pocket, not your life insurance policy. So if you have, let's say, $10,000 cash value accessible, and you want to take a loan out, the $10,000 is still sitting in there in your policy earning interest, and the life insurance company is going to loan you their $10,000. Okay, and depending on the loan provision, you may have to pay the life insurance company interest. However, some life insurance companies, I know one, for example, right now their loan provision, if you take out a policy loan, it's 2% interest. So it's way better than the bank. and your money is still earning, compound interest inside of the life insurance policy as well. So we call it like infinite banking, infinite banking concept. Yeah.
Mm-hmm.
And then
Well,
let's say you took out 10,000, and let's say you had a life insurance death benefit of 100,000, and something happened, you passed away, and you weren't able to pay that $10,000 back. Well, what will happen is the life insurance company will just reduce your death benefit by the outstanding loan balance. So your beneficiary will get 90,000 instead of the full 100,000, which still is pretty good.
yeah, that's great. I love that. I love that idea because it's not like taking out a loan or credit off of your stocks. Because from my understanding, when you do that with your stocks or your investment portfolio, then it affects your compound interest. But with this, it doesn't. It still stays the same. You still have your cash value. You're just like taking a loan out of the bank of your insurance company. So that's great. So how long would you say
you would be if you were to take out, if you were to liquidate some stocks and stuff, you may be subject to capital gains tax as well. So if people want to bypass that whole tax thing, using the funds in your life insurance policy would definitely bypass that.
Yeah, sounds great. So how long does it take to even build enough cash value, you would say, for a down payment for, I don't know, like 30,000?
Well, it depends because like I mentioned before, your premium payment is, well, a portion of that goes towards the cost of insurance. So that depends on your age, your gender, your medical history, and stuff like that. So if you have a pretty good, if you're healthy and you're young and you are female, because females tend to live longer, their cost of insurance is lower. You could, your premium payment, more of that would be going towards the cash value instead of being eaten up by the cost of insurance.
Can one person just like use their insurance like as a bank? So like, what if I had a whole life insurance and I was like, oh, I have all this extra cash, I'm just gonna put into it. What can I like allocate all of that extra cash that I put into only on the cash value part of the insurance, like a bank savings of some sort? Is that possible?
Yeah, so the difference, whole life insurance, unfortunately, is very rigid. And we say rigid because at the inception of the policy, or when you start the policy, everything is fixed. Your premium payments are fixed, your interest rate is fixed, and your death benefit is fixed. You can't change anything. So whatever your premium payment is, let's say it's $300 a month, that does not change. You cannot pay more, you cannot pay less. And you must pay it, or else your policy will, lapse and be forfeited. So whole life, while it's a good, while it's a product, it may not be the best vehicle for infinite banking. Index universal life insurance, however, or universal life in general. Universal brings in flexibility. So you have a flexible premium payment, a flexible death benefit amount. So now you can put more, you can put less, and the only thing that differentiates each of the universal life insurance policies is how they accumulate interest. So with a fixed universal life insurance policy, your interest rate is fixed. Variable, your interest is attached to the stock market and goes up and down. Index universal life, however, they use the stock market as a reference point. And each insurance company has a guaranteed minimum, meaning no matter what the market does, or no matter how bad it is, they will guarantee you, up to 0% or maybe even 1%. So while everybody lost money in the stock market, your life insurance policy could earn 1%. On the flip side of that, if the market does really well, you are subject to a cap. And different insurance companies have different cap levels. Some insurance companies have uncapped strategies, meaning there's no ceiling. It'll go high as it goes, and you can reap all the benefits. And there are some strategies that give you a bonus multiplier. So whatever, it goes as high as it goes, and then they'll add extra on top of that. So, it all depends on, the life insurance company and what type of index strategies they're offering. So that being said, the reason why the death benefit is also flexible is because, let's say you have just $100,000 life and death benefit, and you're putting all this money into your life insurance and it's earning interest. Well, eventually you can grow that cash value past 100,000. And at that point, what's the purpose of having life insurance, right? So the IRS has a guideline that makes sure all life insurance policies have what they call, it's called a cash corridor. So your death benefit will rise as your cash value increases. So there has to be like a little buffer in between your cash value and your death benefit, because if you have too much cash value and not enough death benefit, IRS recognizes that as an investment product, or they call it a modified endowment contract, and then you can be subject to taxes on any or all monies inside of that policy. So
That's
yeah,
interesting.
life insurance company is aware, so they have that buffer, and as your cash value starts creeping up towards your death benefit will start to increase at the same time.
Okay.
Automatically. So you don't have to, worry about raising it yourself, and how much to raise it by.
Yeah, I think we already answered all the questions that I had in mind. So when one is using this type of method to purchase real estate, they definitely want to consult with someone like you to strategize and come up with a plan. I know for me, myself, I purchased insurance for my kids because after all these years, and by the time they turn like 18 or in their 30s, I did the calculations. Well, they'll have enough money for a down payment. But again, inflation, so I don't know. I made those decisions thinking like, oh, maybe 30,000 is going to be good enough by the time they're old. But they can still use that as part of their down payment because at least it'll be available for them. Or they could use it for a car. So I feel like it's a pretty good tool just to have in your back pocket. And then you can also plan, right, for the future. So yeah, thank you for all your information and your knowledge, Ryan. I appreciate your time.
Yeah, no problem. You mentioned, saving for your kids.
Yeah.
I have some clients that purchased the policy on their children for the purpose of planning for college. So, they're putting away, $200-$300 a month into their life insurance. And because they're kids, their cost of insurance is really, really low. So the majority of that premium payment is going towards the cash value side that's earning compound interest. And by the time they're 18, they'll have, enough money to, take loans out to pay for tuition, and then they don't put the money back. They just take the money out, pay for tuition, and they continue to pay that premium payment all the way up until age 65. Eventually, the kid will take over the payments. But by the time they're 65, even though he took out like $100,000 after, to go to college and stuff, they would still have, over $1 million as far as, retirement or funds, So And I think it's another, I wouldn't say it's better than a 529 plan, but it's definitely different, because what if your child doesn't go to school? You know, they say, college is not for me. I want to be a realtor just like my mom. I don't need to go to college, right? I can just study and take a real estate course and get my license, right? Well, all the money in the 529 plan, it now becomes taxable. However, I heard that they just passed a law that now, if your child decides not to go to college, you can convert that to a Roth IRA. So it's not a total loss. It's not taxable. However, because now it's a Roth IRA, there is an age restriction, and they cannot touch the money until they're 59 and a half. If they do, there's a 10% early withdrawal penalty from the IRS. So definitely a different option. I wouldn't say one solution is better than the other, but you know, definitely there's a lot of tools out there at people's disposal that maybe not a lot of people know about. So it's best to consult with the expert, you know. I wouldn't say I'm an expert, but I know a thing or two about a thing or two. So
yeah, I mean, and you provide free consultation, so even if it's like people looking to have cash like funds available to them, like there's strategies, there's tools out there that we can utilize, we can provide them, whether it's buying, you know, real estate or providing funds for their kids' college or future car. Yeah, these are all valuable tools that they can use. So, well, thank you, Ryan. I appreciate your time. I need to go and take care of my child now. Thanks, Ryan. Appreciate your time. I'll talk to you later.
Jennifer Peele, keeping real estate appealing, achieving your goals through creative, aggressive, and innovative strategies.